Jeremy Siegel, professor of finance at the Wharton School of Business. He wrote Stocks for the Long Run, a book that several publications have called one of the best investment books of all time. And Jeremy, I want to talk to you a little bit about the Fed, because often when I'm arguing with people about when the Fed's going to raise rates, if they ever do raise rates, again, I bring up your name, you have thought at times that the Fed is behind the curve, and you expect, I think, sooner rate hikes compared to your peers here. What do you think about the Fed raising rates, inflation right now?
Well, I think they've got a problem. We look at what is bedeviling the market, and yes, we see what's going on in Japan, but these inflation numbers are a bit troublesome. Oil continues to be strong, and it was strong even before we had the Mideast situation. Food, as we know, the biggest rise in 25 years on the consumer price index. They cannot ignore this forever. And that's why, my feeling is, look, Trichet has already said with the ECB, maybe we'll raise in April. That's certainly way too soon for the Fed. But I think by autumn, Bernanke's got to put out some words that he is looking and thinking of exiting from this enormously accommodative policy they've been following. So
at some point, yes. Jeremy, do you have concern that all of the exogenous problems we have, Europe, now the Middle East, now Japan, could lead to a slowdown for the market, maybe for the economy, and then the Fed is also put in the position where it has to raise rates? I mean, isn't that the worst case scenario?
Well, there's always things for the market to worry about. I start worrying when no one worries. Then we're at a top for the market. In terms of when the Fed starts raising, history shows yes, there is a little tremble, a little correction that comes in, but the early tightening of the Fed does not stop a bull market. It is only the very late tightening, when they really have to move against the excesses and the inflation, that we really see stocks having trouble. So, yeah, there certainly will be a flutter when Bernanke has to make that shift. But my feeling is that won't stop the bull market. Also, one remembers, mild inflation, even 2 to 4%, that's a little bit above the Fed's target, has actually been a sweet spot for stocks historically. Stocks are real assets. They tend to move with prices. It gives corporations and firms pricing power. So I'm not worried about a mild inflation. I think that's not going to be a problem for stocks. Obviously, anything more than that, 5–6%, the Fed would have to move very aggressively.
All right. I want to bring a trader's perspective into this conversation with Jeremy. Tim Mulholland, managing partner at China America Capital Company. He's out at the CME Group in Chicago. Tim, where are you in all of this? What a week full of news, and the market certainly responded. Are you worried at this point? Are you calming down? Where are you here? And what are you hearing from traders, too?
Well, I mean, you get that left tail event here, and a shock that we got to the system. So, these type of, in case overreaction, we were down 16.5% in the Nikkei earlier this week, within 2 days, and the yen moving 7 big figures. Those are, these are shocks to the market. So you take, but I think going back to Professor Siegel's point, I do agree with him that, but except on one thing, perhaps I might differ, and that the Fed got themselves in a jam here with zero interest rates. And the fact is they talk to taxpayers bailing out from the crisis. It was really savers that did, because savers are the ones still paying for this. Now, when the Fed's going to have to tighten, which I don't think there's even any consideration of it right now, and the same goes for the ECB because of the shock that we got in Japan, and also the ongoing crisis that we have in the Middle East right now. I think it's beyond that point. So I think what you're going to see is some steepening of the yield curve, and when the Fed does have to tighten, it's not going to be a pretty choice.
Hey, we've been talking to a lot of folks today. I want to bring in UBS Chief U.S. Equity Strategist Jonathan Golub. He told Bloomberg earlier that market optimists, well, they should just stick to their guns.
If the market's off by about 5% over the last few weeks, if you were optimistic before, if you're looking at the fact that employment is getting better, manufacturing activity in the U.S. is getting better, the stock market is cheaper now, we were optimistic before, I'd be a buyer at the current level.
Jeremy, Jonathan brings up a good point. We talked about valuations yesterday. One of our guests saying, the market kind of getting cheaper and cheaper. I mean, do you agree on a valuation basis? The market looks pretty attractive.
Oh, very attractive from two perspectives. First of all, on the basis of projected 2011 earnings, we're selling around 13 on the S&P 500, and in a low interest rate environment such as we are in, that's really very low for valuation. So I have no problem on a valuation basis at all with this market. I think it certainly has a way to run. I just, I would just love to see oil and food calm down a little bit, so we don't have to launch into a massive tightening, which certainly would scare the market, and that might come into being. There's a whole question of radiation from the Japanese reactors. I remember what happened with the SARS epidemic and the swine flu epidemic. Actually, those were much scarier in some ways than what's going on in Japan, in the sense that that really had a potential of spreading worldwide. We know that really outside the area right around the reactor, even worst case scenarios, they're talking about maximum 50 miles. I mean, this is not the type of potential that can really, thwart the world economy going forward.
Jeremy, you perked me up a little bit when you said massive tightening. I mean, how likely could that happen from the Fed in your view?
Well, I mean, Bernanke is not there. I mean, there's so many steps to go before we hit that. And Bernanke is going to give a speech that is going to say, our strength is now showing. We're going to remove some of the accommodation. It'll first come probably with raising just the discount rate, and then finally some moves on the federal funds. It's not going to come all of a sudden, because despite how bad the inflation numbers were on the PPI and the CPI this week, the core were almost exactly on target, and that is what the Fed is looking at. So there's no reason for a precipitous move right now. They just have to keep their eyes open for problems.
Hey, Tim, it's Julie here. I want to bring the conversation back to oil a little bit, because as sort of the Japan concerns receded this week, people were focusing more on oil. We had the news out of Libya today about the ceasefire. But what kind of feeling are you getting from your fellow traders? What are you hearing as to, whether people buy it or whether folks are still worried about unrest in North Africa and the Mideast and the effect that'll have on oil prices?
Yeah, I think the Mideast looks like it's a long ways from being over, this movement that's taking place right now. And also, I think it was mentioned earlier, energy prices were on firm footing even before this started. And now with the onset of the crisis in Japan and, what may happen to the nuclear industry going forward, there's going to be even more reliance on fossil fuels going forward. So I think that the concern is that commodity prices and energy prices, it's going to be onward and upward.
Hey, speaking of energy, I want to talk about that a little bit with Adam right now. Adam, you've been following Japan's nuclear crisis all week, and you say there's evidence of a no-nukes substitution effect back here at home.
Well, there are a number of different ways you can generate electricity. In this country, about 45% of our electricity comes from coal, 24% from nat gas, 20% from nuclear. Well, look at what's happened over the past week to both nat gas and coal. Look at that. Nat gas up 8.5, coal up 5. So, Professor Siegel, is it possible the market's telling us that it doesn't want nuclear and you need to start buying these other assets? Is that a legit long-term play in your view?
Well, yeah, I was surprised the first few days nat gas didn't move, and now it's moved recently. The good and bad thing about that, I used to say, hey, one of the great things about oil going up this time, natural gas decoupled from it. If we get a rise in natural gas, that is as punishing to your pocketbook for us here in the Northeast in the cold climate, because we were on natural gas. We didn't have any of the problems of the rising oil prices. So it's an opportunity, certainly, for those people in the natural gas industry, but we also have to look at the potential for the consumer, which is not favorable.
Tim, 5 seconds. Going to be a rough week on Monday or a rough day on Monday? What do you think, just quickly?
Well, over the weekend, it's hard to say. Developments will dictate, but I think we're going to see more volatility going forward for sure.
All right. Seems to be the name of the game. Tim and Jeremy, thank you so much, guys. Have a great weekend.